Hey everyone, it's Jay Soloff here at Investors Alley. This is our trade of the week. So I'm at marketchameleon.com looking for some interesting trades that have happened this week. And what I do is I like to go to this options block trade screener and sort by quantity and see what the biggest trades were and if any of them were really interesting. And so sure enough, there is a massive 180,000 by 180,000 trade in UUP. So going to UUP, you can see it is an ETF that tracks the US dollar versus a basket of other currencies. So looking at the chart of UUP, you'll see that it's really not that volatile. Okay, so let's go to like a 1-year chart here. You can see it's really not that volatile. It's gone from a bit under 25 to not even as high as 26.5 over the last year. That's because the dollar doesn't move that much versus a basket of currencies. So you're probably wondering, well, what kind of options trade would you want to do with something that doesn't really move? Well, let's take a look at trades here. We can go to the trade screen, and once again we will sort it by quantity. And so what's happening here, this is a roll trade. So with the stock just over $26, someone's closing out their June position and moving it to July. We can tell that they've closed this out for a penny and that they've opened the new one for 17 cents. And so you're probably wondering, well, why even bother closing a trade? It expires today. So why bother closing a trade for a penny? Well, when you're dealing with 180,000 options, that's $180,000. Every penny is $180,000. So it makes sense to save that. You know, they wanted to leave it on this week in case the dollar moved down on the interest rate news and the FOMC meeting. So they probably wanted it to stick around for this week, and when nothing happened, they closed it for a penny and they moved it out next month to July. And you can see, even though they only paid 17 cents, that's over $3 million in premium. So the premium is all that they can lose on the trade. And of course, in this case, it's a lot of premium. But if the dollar drops below 26, that's where they can start making some real money. So going back to the chart here, kind of look at what this might mean. 17 cents for the options means that 25.83, so somewhere right around here is the break even. So very realistically, if the dollar goes down, then they can make a whole lot of money if it goes down to 25, right? Because that's, 80 some cents at $180,000 per penny that they can make. And we're pretty much near the top here, so there's not a lot of upside risk, most likely, particularly with the idea that rates are going down. And that's probably what this trade is. It's either a bet that lower interest rates are going to cause the dollar to go down, which if other currencies don't move as the dollar goes down as interest rates go down, assuming no other currency moves. Of course, other currencies move, which is why it's not just a straightforward prediction, but it is a strong possibility as rates go down. The other thing is it could be a hedge. It could be a position that has a lot of stock position that's heavily reliant on the strength of the US dollar, and they want to hedge by buying puts in case the dollar goes down. So there's a couple reasons possible for this trade. And then if you look at a longer time horizon, you can see that this is still pretty much near the top over the last 10 years. So not a lot of upside risk. Meanwhile, it's gone all the way as low as, let's say, 21, which would be millions and millions of dollars. Now, we're probably not going to go down to this level, but you never know. And even here, closer to 23, that would be millions of dollars of gains or protection if it does go down. So this is the sort of trade you could easily make in your own account here. You could just look and you could see here, this is today's trade. You could see it traded 180,000 times. It closed for a penny. They went out to the next monthly expiration, which is July 19th. And here you could see it closed again, 18 cents, traded over 180,000 times. It's a little bit higher now, so you might have to pay 19 or 20 cents. But you could easily do the same sort of thing in your own account if you're bearish on the dollar, if you think interest rates are going to push the dollar down, or if you just want to hedge your portfolio. This is sort of a cheap way to do so in the face of lower rates. So very interesting trade and the sort of thing you could easily do in your own account.